Doc, Sean Duncan, SMD Consulting and Accounting again. Are you a real estate investor and we're told, hey, you know what? Cash out that retirement account. Retirement accounts stink and they're not producing. You can make more money in real estate. Please, I'm begging you, wait before making that decision. Let's talk about it. But first, disclaimers. All righty, everybody. Thank you for the disclaimer. So let's talk about this. We have a lot of physicians and physician families that also dabble in real estate. It's awesome. Real estate is amazing. I love it. I invest in it. There's all kinds of varieties of real estate. You might want to do fix and flips. You like renovating and you've seen it on HGTV and you can fix up a house and make $1 bajillion renovating it. You might want to buy single family houses and just rent them in long-term rentals. You might want to invest in a multifamily syndication. That is flying around a ton in the medical space. There's gotchas with that. If you're ever interested in more details, we can talk about it. They're amazing, but just let you know, lots of doctors invest in those. There's commercial investments. A lot of groups will pool together. There's what they call, I call them kind of baby multifamilies. Those are your 5, 10, 15 doors, independently real estate owned IROs of multifamily units. There's land. There's so much cool stuff. There's short-term rentals. Of course, the Airbnb market is a mess right now. So if you're getting ready to do that, let's talk because it's cool. I have some too, but it has its strife as well. So it's all up and down and flows and things. But if you're investing in real estate, here's the thing I keep running across. Way too many groups are giving advice and teaching on how to do real estate investment. And that's great. I want you to learn this stuff. My gosh, there's some cool things out there. The thing that keeps coming up, and it comes up in multiple organizations, is they will pitch to you and quite frankly, lean on your frustration with the stock market. Now, when the stock market's going bonkers, they'll say, look, it's only making 10%. The real estate can make you 30%. You can double your money in 2 years. That may be true. But they're telling you because real estate can make more money, you should get rid of all of that other stuff that is making less. Now, hold on. Why does real estate sometimes make more money? Because there's risk. Anyone remember 2008? Anyone notice the values of properties right now dropping? It's risk. There's risk involved. Risk typically yields a higher result, but can also have a negative result in capital calls and other kinds of crazy stuff. So as a investor, you want to make sure you're working with your licensed financial advisor to collaborate with them on your risk and your diversification. I can do math right now to tell you why all of your money should be in the stock market. I can do math and build spreadsheets to tell you why all of your money should be in real estate. I can do math to show you why all of your money should be invested in life insurance, which, by the way, is an investment vehicle in certain ways too. We could talk crypto if you want to. I can talk investing in puppy mills. I can do math. I can torture the numbers to tell you why something will always be better than something else. That's why diversification is powerful. I am not giving you investment advice, but please understand that's why it exists. So if anyone ever tells you all of your money should be in blah, they're inherently wrong. You should always have a diversified strategy. Now, as it relates to real estate and securities, way too many people are being told, go cash out the retirement account, pay the taxes because you're going to make so much more money on real estate. All right, maybe you will. I have seen many, many times people double their money in 2 to 3 years in real estate. It's getting a little harder right now because of the market being what it is, but I've seen it. So if you can double your money in 3 years, that's going to outperform your stock. So why not? The problem is, what are the real tax implications? And I'm going to give you a very specific, true example of someone that got this advice. And this is what gives me heartburn as an advisor, because I am a fiduciary. I am obligated, and I would do it anyways, to give you advice in your best interest. And this wouldn't have been one of those moments, but unfortunately, it was too late. Lady comes in. It's around August of the year, maybe July. It's later in the year. And she had told me as a prospect, hey, I cashed out my retirement account in January. I'm ready to invest in real estate. I am excited. It's like, what do you mean you cashed out your retirement account? I cashed the whole thing out. It was a $500,000 account. I'm ready to invest. Let's do this. Like, what, what was the tax implication? It doesn't matter. I'm going to make more money. Here's the problem. She was married to a physician. Physician made about $800,000 to $900,000 of taxable income a year, which put him in a 37% bracket. That means immediately that $500,000 had 37% tax assessed to it. Also, she was 58 years old. See, at 58, you also pay the 10% penalty because you cashed it out too early. She could have just waited a year and a half and not paid 10%. But guess what? She's now paying 47% tax. Now, it's been several years since I looked at this, but she was also a resident of California. And for you California doctors, you know that's a beating. So what was it, 12% extra, whatever the number was, I can't remember. But over half of her value was lost. Over $250,000 was just Kaiser Soze sent to the IRS. Now, look, you can make money in real estate. You can often double your money in real estate. But I don't want you starting with $200,000 to try to make up to get, if she really had, it was right around 210, something like that, $210,000. If she does double her money in 2 years, you know what? She's not even back where she started. She's at 420. She had $500,000. And over that 2 years' time, what would the $500,000 turn into? I don't know. Actually, the market went fairly well after that, so she would have been really happy with those returns. But she's not even back to baseline. See, the issue is, and this is a core financial investment principle, the losses hurt more than the gains are beneficial. It's almost like being a football coach. The losses hurt more than the wins feel good. When you lose 10% of your account, it doesn't take 10% to get back. It takes more. If your $100,000 turned into $90,000, but then you get a 10% win, you're back to 99. It takes more to recover from losses. So losses are important, and taxes should be deemed as losses in some cases like this. So when you're talking to somebody or when you're being trained, just cash it out. Securities are stupid. Wait, real math matters. Now, do we do this sometimes for people? Absolutely. Sometimes they're too heavily concentrated in the securities, and we do want to, but we might dole it out in smaller chunks. We might manage and strategize. They're in a 24% bracket. Let's do it at 24 so I don't shove them accidentally into 37. Because by the way, if you're in a 24% bracket and you cash out $500,000, congratulations, you now are in a 37% bracket. You can accidentally shift your bracket up by doing this too. And then understanding your age. Do you get the 10% penalty? There's rules where you can split it among spouses and not pay the 10% penalty. Some really neat stuff, but there's calculations, there's penalties, there's things to consider. So if you're interested in real estate investment, cool, love it. It's awesome and terrifying and stressful and exciting and lucrative, but it's got risk. I don't want you to start 3 steps back in an effort to try to get 2 steps forward. I want to make sure you're continuously moving forward. And one of the big whammies that happens, and it's great marketing, especially if you're frustrated with the stock market. I won't say it's preying on you, but it's kind of preying on you. It's preying on that fear of the market or the frustration. Be very analytical. Work with your professionals, make sure that you're going into the situation eyes open, and don't end up like this lady losing well over $250,000 of her money when she's approaching retirement and then having to work just to get back to baseline, because it's work to do real estate. It's not just passive. So if you've ever got questions, please come and ask us. Please ask your professionals. I don't want you in this situation. It really does kind of traumatize me when I have somebody come in and I can't fix it because it was so late. We were beyond the statute of limitations to put the money back. I want you to win. I want you to grow. I want you to accumulate wealth. John Duncan, SMD Consulting and Accounting. Guys, hey, Doc, hopefully this was helpful.